success as a real estate agent? Let's see where I left off. Mortgage interest rate mistakes. Even experienced agents make these two classic mistakes when talking about interest rates because they haven't been educated in the origins or key influencers of mortgage interest rate. Most agents typically default to an "I don't know" response or punting the discussion to their mortgage lender. Both of those responses leave you on the outside looking in, and you're not really positioning yourself as an expert. Certainly, when you have no idea, it's better to say clearly that you don't know. But mortgage interest rates are actually quite easy to understand if you have a few basics. Most consumers and agents think that mortgage interest rates are set by Federal Reserve Bank based on their Fed rate that is charged to banks. The Federal Reserve has been in the news consistently over the last handful of years because it has raised the federal rate to reduce inflation to 2%. They have increased that rate to the highest level we have seen in over 20 years. This had some influence on mortgage interest rates, but there is no direct connection between the Fed rate and the mortgage interest rate a borrower pays. The Federal Reserve rate directly influences short-term money like credit cards, home equity loan, of-credit loans, and commercial loans. The mortgage interest rate is closely tied to the 10-year Treasury bond. If the 10-year Treasury goes up by 25 basis points, you will see mortgage interest rates increase that much or more the following day. The spread between the 10-year Treasury and 30-year fixed mortgage interest rates, typically is about 1.25 to 2%, depending on the lending and the other terms of the mortgage. So if the 10-year Treasury closes today at the 4.25%, you can expect in normal markets a rate between 5.5 and 6.0% for a 30-year fixed mortgage rate. Little tidbit, Trump just passed something, or at least he's like putting it out there, for a 50-year mortgage rate. Another 20-year mortgage rate. It'll change things dramatically. It not only like brings in the opportunity for your mortgage to be a lower rate, but like it has a higher like overall interest rate, but you can refinance, Easy peasy. Anyways, the expectation to this rule would be when banks and lenders expect rates to decrease. At times when banks export rates to cycle down the bank's charge